presentation contains current opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compak Asset Management YouTube update for December 3rd, 2021. I'm Mo Ansari, President of Compak Asset Management and host of Market Wrap. You can get the daily update, the daily 1-hour broadcast, simply by going to the Apple Store and downloading the app for Market Wrap. You just type in Market Wrap with Mo Ansari and you will get the free update every day. The 1-hour broadcast that I do on a daily basis, you can have that downloaded to your phones and then you can listen to it at your convenience. We have a couple of exclusives here. First of all, I'm going to, if you would like to find out what we're doing for the next quarter, I'm not going to do a webinar this month. So all of you can just set up an appointment and I will be more than happy to spend an hour with you, let you know what you're doing, what we're doing, and how that fits in with your overall perspective. If you want my perspectives on the market, the economy, and where we think the stock market's headed, you can just simply go to compak.com and set up an appointment. On the 7th, I'm going to be in San Jose. That is where I'm going to do a free seminar. A lot of you are going to attend, but we have limited capacity due to COVID, so we don't have a lot of people. We only have a couple of seats left, but if you are in the San Jose area and would like to come to the seminar, where I'm going to spend a couple of hours going through exactly what we're looking at, what we're doing, and why, and answering your questions, you can register simply by going to compak.com. Let's start with the COVID, Omnichrome. It came on. How did we name Omnichrome? Well, we used all the Greek alphabets. We had the alpha and the beta and so on and so forth. And then we were right here. The next one that we were supposed to have is the new. Well, we didn't want to call it the new virus. Everybody would have been confused. Said, wait a minute, we've got a new virus? We've got a new variant? It's a new variant, but it's not called new. The one after that was Xi. So we could have named it Xi, but then, President Xi of China might have been a little bit upset with the next variant be named after him. So we skipped that also. And so we went directly to Omnicron. That's how we've ended up with Omnicron. What is the implications of Omnicron right now? We don't know. No one knows how quickly it is going to spread. It spread a lot faster in South Africa, about 4 times as fast as the Delta variant. So it is much more contagious. That's what we're hearing so far. We don't have all the scientific data yet. But when we're comparing South Africa to the rest of the world, South Africa only has 24% vaccination rate. So the vaccination rate is very, very low. So how will this progress, Omnicron, in the Western world where we have much higher vaccination rates, or countries where it is much higher? We will have to wait and see. And that is what is causing the uncertainty in the market. No one knows how bad it's going to be. A lot of the reopening trade, as I call it, or the Russell small cap, and I'll take a look at the chart a little bit later on, it has gotten really hammered. I mean, it's up 9% for the year compared to nearly 21% for the S&P. So that shows you the difference. We start coming up. We did come up on the Russell small cap, and now we're back down again. If you look at the reopening numbers, we are still below, about 15% below the jobless claims, or they're still running about 15% higher than where they were with COVID. We did get the unemployment data, which was a mixed report. The headline number dropped from 4.6 to 4.2, even though the number of hires was a lot lower than expected. But overall, it was a good report. And what that does, it still puts the Fed tapering at a faster pace. That means the Fed could accelerate the taper. That means the amount of bonds they're buying, they're reducing it right now. They announced that they would buy 15 billion less in November, 15 billion less in December, but we have a December FOMC meeting, Fed meeting coming up, and the expectation is now, as Chairman Powell said, that they are going to increase the amount that they're going to stop buying, or they're going to taper faster. What that means is they were buying 120 billion, they could bring that down to zero a lot faster, and once they're at zero, they could start raising interest rates. So those are the two things that have caused a lot of anxiety in the market today, and tech stocks were the leader today on the downside. We started out, and here we were, and we were down quite a bit for the week. All the indices were down again. So when you look at all of this, it's just the uncertainty of Omnichrome and how much is the Fed going to accelerate the time frame. I believe the Fed is going to be very, very cautious in raising rates or even increasing the taper, especially with the new uncertainty of Omnicrom. So they might decide after this meeting that yes, we are going to increase the taper, but we are not going to do it right now. That means we're going to start buying less bonds, but not immediately. And if they say something like that, that puts the timetable back again to where they're going to raise rates, and that could give the market a lift. That's what I would not be surprised to see. The other thing that is pushing Fed to raise interest rates faster is inflation. And when we look at the inflation numbers, this green part is energy. That's what we're seeing. It was a major contributor. This is as of October. We saw a major contributor to inflation was oil prices at $85 a barrel. Since then, oil prices have dropped down to about $67 a barrel, where they closed today. They were down 17% in November. They're down nearly 21% from the highs. When you take this part of the inflation equation out and these prices start to come down for energy, I think that's going to have a big impact on the inflation number going forward. The other number that we're seeing is goods and food, excluding food and energy. Well, that is because of supply chain problems. Now, that is a two-edged sword. Right now, we have about 80 ships that were standing out the ports of Los Angeles and Long Beach that are waiting to be unloaded. I believe we're going to catch up on that and unsnarl the supply chain issue that we have. It will gradually go away. We saw the huge demand come in, and the people were just not there because everybody had laid off people during COVID. So the demand came much faster than companies could hire people and get the people to work. And I showed these to you, the numbers on truckers and all of that in the seminars and the webinars. I'll talk a lot more about that. But that's what we're seeing. But now that is catching up. And I think we're going to unsnarl the supply chain. But one of the biggest things that we are not sure about is what happens with Omnicrom in China. China has a zero tolerance policy for COVID. As soon as they get one COVID case, they shut down the whole city. When they shut down the whole city, they shut down the manufacturing also. So if Omnicrom spreads in China, we could see lockdowns in China, and that could affect the supply chains globally. And that could delay the unsnarling of the supply chain, something that nobody's sure of, and that's why we're seeing a lot more anxiety. But inflation as a whole, I think, will start to stabilize in the first quarter and the second quarter of next year, and then start going back down. If you look at the contributors right now, these are some of the contributors. New cars are contributing to inflation right now. They're pushing up PCE, which is the favorite inflation gauge that the Fed looks at. You're looking at used cars being way up there. But if you look at next year, by July of next year, these prices have come down. Instead of contributing to the plus side, they will be on the negative side of inflation. So they will be taking away from inflation. And that will bring, I think, with the energy prices down and some of the other components that have pushed the CPI higher, could start bringing the CPI back down to 3.5%, 3 or 4%, which is still higher than what the Fed wants. But you've heard me talk about this, that I think the Fed will let inflation run a little bit hotter than the 2% area. Looking at the markets, I'm going to start with the Treasury yield today. Instead, I usually look at the S&P or the NASDAQ, but today I'm going to start with the Treasury bonds. The Fed is expected to taper faster. That means they could raise interest rates faster. But when you look at interest rates, instead of going up like they were here, they've started to come down. And today you can see that we are at 1.34, which is way down. We're just slightly off the lows of the year where we were, or at the middle of this year when we were at 1.15. So if we break much below here, the bond market is saying, look, we're not worried about inflation. Usually rates go up when they expect more inflation. Rates go up when they expect the economy to do much better. What the bond market is telling us, the economy is slowing and inflation is going to slow. That's why rates have come down, even though the Fed is expected to push rates up. That is something to watch very carefully. If the short-term rates get above the long-term rates, 2-year over the 10-year, or the 10-year over the 30-year. Those are inverted yield curves. And every time short-term rates go up, the Fed has really stepped on the brakes. And when the Fed steps on the brakes, that usually causes a recession or slowdown in the economy. Something to watch, something we're watching very carefully. And will that impact the stock market? If the economy slows down, that definitely will have an impact on the stock market. Here's what we've seen. When rates initially start to go up, you can see that rates go up, markets go up 82% of the time. There's a point where initially when rates go up, that means the economy is doing really well. That means the Fed is trying to slow down the economy. But there's some point that the Fed raises rates so far that the payments for homes, cars, washing machines, whatever people are buying, people say, I can't afford it. The payments have gone up so much because of the rates being so high. When that happens, that's when we get into a recession. But that usually does not happen until we get 18 months away from when the Fed starts to raise interest rates. Right now, we're not even talking about raising rates. We're talking about slowing down the amount of money that the Fed is pouring into the economy. That's all they're doing, is slowing down, not raising rates yet. So once we get there, we'll have to wait and see. The fear is that the Fed will step too hard on the brakes and push the economy into a recession. That's why long-term rates are not going up yet. Maybe the GDP will pick up a lot more. Maybe you'll see inflation persist, and that where the Fed will be justified in raising rates. But that is what I think a lot of people are worried about right now in the stock market. The Fed might miscalculate that. Looking at the stock market overall, we are back below the 50-day moving average today. We were above it yesterday for the S&P. You can see that everything moves in 5 waves. This is wave 3, wave 4. Once we make a 5th wave top, the market starts to correct back. We had a correction, an A, B, C correction as it's called. We go back and forth a little bit. Then we start a new wave count, which is wave 1, wave 2, wave 3. Looks like we're in wave 4, which is to the downside. Wave 4s are usually messy. They chop around for a period of time, and I would not be surprised to see the market chop around until we get a much clearer picture of what the Fed is going to do and what's going to happen on Omnichrome. So we are going to see more volatility. That's what I expect to see in the short term in the market. Looking at the long-term picture of the market, the S&P, the weekly chart, we have gone up, we've come back down a little bit, and now we're starting to head back up. Looking at the NASDAQ, it broke below the 50-day moving average decisively today. So on the downside, we're looking at support right at this gap in the charts, which is about 14.6. And if we break below that, then we're looking at the 200-day moving average at 14,400. Today, we just closed just above 15,000, 15,100. So there is definitely more downside if there is the expectation that interest rates are going to go up. That's going to take away from growth stocks or the tech stocks because their multiples are based on growth, but the growth multiples come down in value if rates go up. So that's why whenever rates go up, they have a negative impact more on tech stocks. But when rates are going up, the economy is doing well, industrial stocks, cyclicals do well. That's why having the right combination in your portfolio is going to be critical. NASDAQ weeklies, you can see these little dots below the market. Whenever the market hits these dots, usually on the downside, we see the market go down for 2 or 3 weeks. We hit this little pivot dot, as I call it, to the downside this week. So we could see on a weekly basis a couple of more weeks of volatility in the NASDAQ. Looking at gold chart, again, got above, got to about 1875, 1880, came back down, broke below the 200-day moving average. Today we came above it, tested it, but could not quite get above it, which is about 1793 is the 200-day moving average. We need to get above that. If we break to the downside, 1720 is support right about here, and then 1665 is these bottoms that we made earlier on this year, and right here. If you break this, I think that would be a very negative sign for gold, and gold could drop a lot more. But we've got some support right here at 1720 and 1665. This is the small cap index. It was trading in a big range since the beginning of this year, 2350 on the upside to about 2100 on the downside. We broke out above it, and looks like we were getting past COVID. I call this the reopening trade. It looks like we were going to get above it. We went above it, and then Omnichrome came, and it has pushed it all the way back down. Today we closed at 2159. We're back at the bottom of the range. I think 2100 is going to be support. All these support areas that we've seen all year for the Russell Small Cap Index. I think that could be a place to take a look at the Russell and see if you want to add some. I still think Omnichrome is going to be transitory, using one word from the Fed. I think it's going to be short term. It's not going to be as bad as everybody is afraid of. I hope it is not. We don't know yet, but that is my guess at this point in time. Those are my views. Those are a very quick update on what I'm thinking of happening. If you'd like to get a complete update, make an appointment. All you have to do is go to compak.com, set up a personal appointment. We can have a Zoom meeting. We can look at your portfolio. We can look at what we are doing and sit down and see how they mesh together. Also, on December 7th, I'm going to be in San Jose. That is the free seminar. If you want to come, I will be there. 2 hours of all the economic numbers, all the technicals, and all of your questions. I'll be more than happy to answer them for you. Those are my views and my thoughts. I hope you have a great weekend. I'm Mo Ansari, and I will be back with you at the next update. Don't forget, by the way, to subscribe. And if you subscribe, whenever I put up one of these updates, you will be notified. So when you click on both of these, you will get an update every time. Those are my views. Have a wonderful weekend. I will be back with you in the next couple of weeks. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.